Welcome to Metagame. I'm Alex Rock. Today we're talking about the AI infrastructure land grab, specifically what it means now that the cost of admission to the game isn't a valuation or an exit number. It's $10 billion before you've built a single thing. We've got 3 deals this quarter that all bet on the same constraint, and they tell you more about where the smart money is moving than any headline you're going to read today. Let's get into it. $10 billion. That's the entry ticket now, not the valuation, not the exit. The cost of admission just to sit at the table where the AI infrastructure game gets played. Let me say that again, because it should bother you. A single new company launched this quarter with more than $10 billion in long-duration capital commitments before it built anything. Helix Digital Infrastructure. Out of New York, created by KKR, led by Adam Silipsky, the man who ran AWS to a $100 billion annual run rate, backed by KKR, the Kuwait Investment Authority, NVIDIA, and Vistra. Read those names again. A private equity giant, a sovereign wealth fund, the most valuable chip company on earth, and a power utility. That is not a cap table. That is a coalition. And coalitions like that don't form to chase small money. So here's the question that should be keeping allocators up at night. When the winning move costs $10 billion just to enter, is there a fundable middle anymore? Or does this whole layer split into 2 kinds of players with nothing viable in between? Hold that thought. Because the answer is uglier than you think. Let's talk about what Helix is actually buying. And I want to be precise, because precision is the whole game here. That $10 billion is capital commitments, not raised, not deployed, committed, long duration, the kind of patient money that doesn't blink when a data center takes 3 years to light up. KKR's infrastructure platform behind this deal runs more than $100 billion in assets under management, more than $70 billion already invested across digital and power assets. So when they anchor a new entity, they're not experimenting. They're extending an empire. And Silipsky said the quiet part out loud. His framing is the whole thesis in one sentence. Data centers, power, and connectivity, he said, have all too often been built on separate tracks. And that fragmentation has become an industry-wide bottleneck. Read that as a trader, not a technologist. He just told you where the money is. Helix exists to buy out the fragmentation, to become the single throat to choke for the hyperscalers. AWS, Google, Microsoft. NVIDIA is the deployment partner through its DSX AI factory-aligned infrastructure. Vistra is the preferred power provider. One entity. Power, data centers, connectivity, end-to-end. You want compute at frontier scale? You don't assemble the pieces anymore. You call one number. That is concentration by design. Not an accident of the market, a deliberate architecture, capitalized to a level that makes competing on the same field a fantasy for anyone without a sovereign fund on speed dial. Now here's what I love about this quarter. The macro story hides in the details, and I'm going to be honest with you about that because most people won't. There is no clean headline number telling you what share of venture capital went into AI infrastructure this quarter. I don't have it. Nobody handed me a tidy percentage. What I have is deal structure, and deal structure is telling you everything. Let me break this down for you. When you can't get the aggregate number, you read the shape of the deals instead. The way a poker player reads the size of the bet, not the cards. And the bets this quarter are shaped like a barbell, enormous on one end, tiny and scrappy on the other, nothing in the middle. That shape is the story. Back to the tape. Because the thing Helix is racing to solve, the thing everyone is racing to solve, isn't chips. It isn't floor space, it's power. Power is the binding constraint on AI growth. And once you see that, every deal this quarter snaps into focus. Take Utilidata. Out of Ann Arbor, Michigan. Embedded AI for the power grid. This quarter, the company completed a $100 million Series C, closing a $40 million extension on top of an initial $60.3 million round from last spring, led by renowned capital partners, with Keyframe Capital in the mix, and prior participants including Quanta Services and, look at that, NVIDIA again. Their product is called Carmen, rack-level power orchestration built on NVIDIA's Jetson Orin Nano. And here's the number that matters. Utilidata says Carmen can unlock up to 50% additional usable capacity at its first commercial deployment with Next-Gen Cloud in Montreal. That's the company's figure, single source. So hold it loosely. But think about what 50% more usable capacity means when power is the thing you can't get enough of. You're not building more. You're squeezing more out of what you already have. Software as a crowbar against a physical constraint. That's why the capital's flowing there. So that's the top of the barbell and the software layer feeding it. Now let me show you the other end, the scrappy end, and this is where it gets interesting. LM Funding America, NASDAQ ticker LMFA, out of Tampa, a Bitcoin treasury and mining company, and this quarter they announced they're pivoting into AI high-performance computing, a Bitcoin miner, repurposing its bones for AI compute. Now, I'm not here to talk about their stock. Small cap, share price under $1. That's not the interesting part. The interesting part is the model, because these people already own the one thing everybody wants: power. 26 megawatts of wholly owned operational power capacity, built from zero in about 15 months. And the average power cost, 4.6 cents per kilowatt hour. The company calls that among the most competitive in the sector. And you know what? Cheap power is cheap power, whether you're mining Bitcoin or training a model. The company estimates that at full 26 megawatt AI build-out, that capacity represents a $20 to $50 million annual revenue opportunity, $800,000 to $2 million of revenue per megawatt per year. Now, that's a company estimate, contingent on full build-out and additional financing, so weighted accordingly. And the build-out isn't free, $10 to $12 million per megawatt to actually stand it up. But sit with the model for a second. Not chips first, not real estate first. Power first. Find cheap electrons, then figure out what to do with them. That is the power scavenger play. The bottom-up version of exactly what Helix is doing top-down with $10 billion. And that's the whole picture, isn't it? 3 deals this quarter, every one of them a bet on the same constraint. Helix buying coordination at frontier scale, Utilidata selling the software that squeezes more out of every watt. LM funding scavenging cheap megawatts from the bottom. Same thesis, same enemy. Wildly different weight classes. Jensen Huang put a bow on it. AI, he said, is driving the largest infrastructure build-out in modern history. Fine, inspiring. But pair that quote against the $10 billion ticket it now implies, and the sentence stops being a vision statement and becomes a warning. The largest build-out in history is also the most concentrated, because a build-out that big has a price of admission that small. So what does this mean for you? If you're an allocator, the barbell is your problem. On one end, mega platforms fused from private equity, sovereign wealth, and the chipmaker itself, playing a game you cannot enter without billions of long-duration capital. On the other end, opportunistic power scavengers, small operators chasing stranded megawatts at 4.6 cents a kilowatt hour. And the fundable middle, the classic venture-scale infrastructure company writing a check that isn't $10 billion and isn't a repurposed Bitcoin mine. That middle is getting very thin. The one clean venture play I can point to this quarter, Utilidata, isn't building capacity at all. It's selling the tool that makes someone else's capacity go further. That tells you where the venture-scale opportunity actually lives now, not in owning the power, in optimizing it. Here's the competitive frame, and this is the part smart money already gets. The rest of the market is still watching AI like it's a software story. Models, apps, chatbots. They're reading the front page. You just read the deal structure, and the deal structure says the war is being fought over electrons and the balance sheet's big enough to secure them. The chips are downstream of the power, the apps are downstream of the chips, and the power is downstream of who can commit $10 billion and wait. So back to the $10 billion ticket I opened with. Is there a fundable middle? Look at the barbell one more time. $10 billion on one end, 26 scavenged megawatts on the other, a single $100 million software round bridging the gap by refusing to touch the physical constraint at all. That's your answer. The infrastructure layer isn't consolidating, it already consolidated. The only question left is which end of the barbell you're standing on, because there's a lot less room in the middle than there was a quarter ago, and everybody's about to find out at the same time. Thanks for listening to Metagame. I'm Alex Rock. We'll be back next episode with more deal structure, more data, and less noise. See you then.
Grab news. Thomas.